We are covering the 7 top actively traded stocks that are bullish today. While watching price actions, let us inform you our review on KVUE. Kenvue Inc. is a consumer health giant with a broad portfolio covering everything from pain care and cold remedies to skin health and beauty. Their brands are household names like Tylenol, Neutrogena, Listerine, and Band-Aid, and they have a global reach, distributing products in over 165 countries. Now let's talk about the stock. Kenvue recently caught some attention from analysts, with Barclays reaffirming their hold rating and setting a price target of $23, slightly below its current trading price of $23.40. Interestingly, Barclays also raised their price target from $21, which shows a bit more optimism, but not a strong push to buy. Their focus on slower consumer demand, especially in the U.S., indicates that headwinds could be ahead, and they're taking a cautious approach. Other analysts like Jefferies have maintained a buy rating, which adds some diversity to the mix, but overall it's a more neutral stance for now. One thing that stands out is the recent insider activity. There's been an uptick in insider selling, like the group president of EMEA and LA selling 17,100 shares for over $393,000. This could signal some concern from within the company, though it's not necessarily a red flag. Despite the mixed analyst ratings and insider activity, Kenvue did see a small bump of 0.85% today, so there's still some investor interest. If you're thinking about jumping into this stock, it's clear there's potential, but also some caution due to market conditions and internal movements. So, if you're holding, it might be a good time to keep an eye on their upcoming earnings report for any updates that could impact the outlook. Our review on VOD. Vodafone Group Plc is a global telecommunications powerhouse, serving over 330 million customers across 15 countries, with a strong footprint in mobile, fixed services, and advanced tech like IoT, AI, and quantum computing. They're also big in cybersecurity, cloud, and digital services, offering solutions like mobile private networks and multi-access edge computing (MEC) to businesses worldwide. Now, in a recent move to support the digital transformation of small and medium-sized enterprises (SMEs), Vodafone launched a new cybersecurity center in Germany. This initiative focuses on helping SMEs navigate the increasingly complex world of cyber threats. Given the growing importance of cybersecurity, especially for smaller businesses that might lack the resources for robust defense, this move positions Vodafone as a key player in a niche market with growing demand. The stock reacted positively to the news, ticking up by 0.96%. It's a sign that the market is seeing this as a strategic move to boost Vodafone's presence in the SMB space, which could lead to new revenue streams. For investors, this is another example of how Vodafone is adapting to changing market needs, especially as cybersecurity continues to be a top priority for businesses of all sizes. While this might not be a game changer overnight, it does add to Vodafone's reputation as a leader in the tech-driven, security-first world of telecommunications. If you're keeping an eye on Vodafone, this could be a small but promising step forward in their broader strategy. Our review on MRK. Merck Co. Inc. is a powerhouse in the biopharma world, particularly known for its oncology treatments. One of its biggest assets is Keytruda, which has been a major revenue driver, making up about 46% of the company's total income last year. The exciting news is that Merck just got the FDA's attention, as the agency has accepted their filing for a subcutaneous SC version of Keytruda. This filing could be a game changer if approved, as it's expected to make the treatment much more convenient for patients and healthcare providers alike. Currently, Keytruda is administered via a process that takes over 30 minutes. But with the SC version, Merck aims to cut that down to just about 2 minutes, dramatically improving patient experience and freeing up valuable time for healthcare professionals. It's also expected to streamline the entire treatment process, reducing in-chair time for patients by almost 50%, which could really ease the load on healthcare facilities. On top of all that, the SC version is expected to be protected by new patents, providing Merck a solid defense against generic competition that could threaten the 4 version after 2028. Investors seem to be on board with the news. Merck's stock is up 1.86% today, reflecting the optimism surrounding this development. While the stock's been down about 11% so far this year, today's pop shows that the market is getting excited about Keytruda's future. If this SC version gets the green light, it could not only improve the treatment landscape for patients, but also secure Merck's dominant position in the oncology market, making it a solid play for the future. This news adds another layer of strength to Merck's portfolio and reinforces the company's commitment to innovation. Our review on WBA, Walgreens Boots Alliance Incorporated, is one of those companies that's deeply ingrained in the healthcare and retail space, running everything from Walgreens drugstores in the US to Boots in the UK, and offering a wide range of services. Recently, they've had to deal with a legal bump in the road. Walgreens agreed to pay over $2.8 million to settle allegations under the False Claims Act for inflating prices on certain generic medications submitted to Medicaid programs in Massachusetts and Georgia. Basically, between 2008 and 2023, Walgreens reportedly submitted higher prices than the actual usual and customary amounts for some medications, which led to Medicaid overpaying for them. The settlement aims to close the chapter on this issue, though it's a relatively small sum in the grand scheme of Walgreens' operations. The company did face some legal heat over this, but it seems like investors aren't too concerned. The stock is actually up 0.27% today, which shows the market isn't reacting too strongly to this news. That being said, even though the payout is manageable for Walgreens, it's still something investors should keep an eye on, especially considering the company's wide range of operations. While this issue doesn't seem to be causing any massive disruption right now, reputational damage or any ripple effects could be something to watch as Walgreens continues to expand its healthcare footprint. For now, though, the stock appears to be holding steady, and the company's focus on its healthcare segment might keep its long-term prospects on track. Our review on MDLZ. Mondelez International Incorporated is a snack giant that's probably in your pantry right now. Think Oreo, Cadbury, Ritz, and more. They're making a name for themselves, not just in sweet treats, but also in snacks, cheese, and beverages across the globe. Recently, they've had some good news from Wall Street. Citi raised its price target for Mondelez from $63 to $75, keeping a solid buy rating on the stock. The reasoning behind the price bump? Well, the firm updated its models based on several factors. Cocoa futures are trending lower for the coming years, which helps with costs. Plus, the company's U.S. market share is showing some signs of improvement. With these updates, Citi expects Mondelez to see better earnings growth in 2025 and especially in 2026, as pricing moves and lower cocoa costs drive growth. This all translates to a more optimistic outlook for the snack powerhouse. It's worth noting, though, that cocoa prices have been incredibly volatile recently, with supply chain issues hurting production in major cocoa-growing regions. While this may have caused headaches for some competitors, Mondelez seems to be positioned well, having hedged against some of these fluctuations. The company is also exploring innovative moves in the food space, including lab-grown chocolate substitutes, which could shake up the entire chocolate industry. On top of all that, the stock is up 0.33% today, reflecting investor confidence in these developments. Even with the cocoa price fluctuations and the future challenges in the market, Mondelez's solid brand portfolio and strategic moves make it one to watch for potential long-term growth. It's clear that the company is not just riding out the storm, but looking ahead to how it can adapt and lead in the snack market of tomorrow. Our review on BMY. Bristol-Myers Squibb Company is a global leader in biopharmaceuticals, focusing on transforming the lives of patients with serious diseases. From oncology to immunology, their portfolio includes breakthrough therapies for a variety of conditions. Recently, the company had a significant development in its oncology pipeline. The European Medicines Agency's Committee for Medicinal Products for Human Use, CHMP, issued a positive opinion for Bristol-Myers Squibb's Opdivo, nivolumab, combination treatment for resectable non-small cell lung cancer, NSCLC. This recommendation is based on the results from the Checkmate 77T trial, which showed that Opdivo, when combined with platinum-based chemotherapy, followed by surgery and Opdivo monotherapy, significantly improved event-free survival for patients at high risk of recurrence. The positive opinion comes after Opdivo's U.S. approval in October 2024 for the same indication. With the European Commission set to review the CHMP's opinion, approval could be on the horizon. The stock responded positively to this news, up 1.9% today, reflecting optimism around the potential for Opdivo's expanded use in NSCLC. This approval would not only bolster Opdivo's position as a key treatment in lung cancer, but also strengthen Bristol-Myers Squibb's growing oncology portfolio. Investors are clearly reacting to the promising trial results and the potential for broader market adoption in Europe. With ongoing studies in other tumor types and a strong pipeline, the company is positioned to continue leading in the fight against cancer. Our review on HMY, Harmony Gold Mining Company Limited, based in South Africa, is one of the world's leading gold mining companies, with operations across South Africa, Papua New Guinea, and Australia. Despite being a major player in gold mining, the company has been facing some challenges recently. Bank of America's analyst Jason Fairclough maintained a hold rating on the stock, mainly due to high costs and declining production. Even though there's a positive outlook on gold prices, with predictions suggesting that gold could hit $3,500 per ounce, Harmony's profitability remains quite sensitive to price fluctuations because of its high-cost structure. Another concern that's weighing on the stock is the company's track record on safety. There have been fatalities in the past, and while management is working to address this issue, it remains a significant concern. On a brighter note, there are some opportunities for growth, particularly with the Mponing reserve conversion and the Eva Copper project in Australia. But all in all, Fairclough's cautious tone reflects the fact that while the gold price boost is promising, Harmony still has a lot of hurdles to overcome. Interestingly, despite the cautious outlook, the stock saw a nice uptick today, gaining 9.5%. This could be linked to the overall rise in gold prices, as investors tend to gravitate toward gold miners during times of uncertainty, seeking safe haven assets. While the stock has its challenges, the recent price jump suggests that investors are somewhat optimistic, especially if gold prices continue to rise. It's a situation where investors are watching closely, weighing the risks and potential rewards as the company navigates these issues. Please subscribe, give the video a like, and watch more from our playlist. Thanks.